Hey everyone, welcome back to All Things Home Loans, Credit, and Real Estate. I am your host, Deb, the Mortgage Queen. So let's start learning. Hey, it's the Mortgage Queen. We're actually going to talk about a really fun thing today, the loan estimate. I have wanted to explain the loan estimate for quite some time. I see quite a few posts on social media that actually take the loan estimate. They do like the talking head thing and they're like, hey, this is what section A is and B, and that's all fine and dandy. But I'm hoping that you who are watching this actually have a loan estimate tangibly in your hand and you're just trying to understand it line by line. And then also, what I think is amazing is people don't read the forms that I give them. And I think, hey, borrower, here's your set of 56 disclosures. There's probably 5 you really should pay attention to. The rest of it is just kind of make sure you have insurance, make sure you pay your payment on time, don't commit loan fraud, But the loan estimate is 3 pages of very important information, and it's really easy to just click, 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 and not pay attention. So I'm actually kind of excited because I suppose I could just share this video with my clients and say, hey, go ahead and sign everything, but maybe when you're done signing, go back to the loan estimate, follow along with this explanation. So here I am, the Mortgage Queen. We're going to go over the loan estimate in a deep dive and basically be able to understand every line. And some of it's obviously pretty self-explanatory, but I want to go from the top to the bottom, so I actually have one in my hand that we can talk about. Just kind of a little bit of a history behind the loan estimate. I feel differently about the loan estimate and when it came out. I've been in the industry long enough that the good faith estimate and the truth in lending were there first. And I understood the truth in lending. I understood it enough that I could explain it to the borrowers and answer questions. There were so many loan officers that had no idea what the top 4 boxes of the truth in lending was. And I understand like the reason between the uniform documents of the loan estimate being all in one place and not having the truth in lending and the good faith estimate. There was some shady stuff that went on. People just adding closing costs at the end and adjusting loan terms. The borrower found out at the closing table. So there's obviously a reason why some of these things came about. But it's more frustrating to me than anything because it's just like everything in the mortgage industry. The bad apples cause problems, and it turns into either a new law that has to come out, a new disclosure that has to be signed, a new rule of some sort, because the bad apples either don't know how to do their job or they did it wrong or they did it shady. I really feel like the people that were in the loan officer seat, if they would have understood the actual truth in lending and they did not try to do crap at the end, we wouldn't be in here with a loan estimate. But anyways, it's neither here nor there. The loan estimate, in my opinion, if you understood the truth in lending, the last part of the loan estimate I think is actually more confusing for a consumer. But to each their own. I uh, I live by this little golden rule of he who has the gold makes the rules, and it ain't this chick. So I have to just follow the rules and do the job that they asked me to do. So if you have your loan estimate, pull it out. I want to go from top to bottom with this, and it's actually really exciting for me to do this because I don't know, because I don't really care about the form, but it has a lot of information that we should probably care about. How about that? Because I do my job ethically and there's not stuff on here I'm trying to hide. I can explain every bit of it, and I hope that people ask me questions because I would much rather answer the questions than to have them get to the closing table and say, well, I never knew. Well, you signed 5 documents along the way that said what it said, so let's look at it from the beginning. Go crazy and actually look at the paperwork you're signing. All of us. That's a rule of thumb for the whole world, not even a mortgage world. Everything. Read it. All right, so let's start at the top. Obviously, at the very beginning, the very, very top of that is going to be the lending institutions that's lending. In my case, I hope it's mine, but anyways. And then obviously loan estimate. On the left-hand side of the top, it's just very basic information. The date that this actual form was issued. And that's kind of a critical thing. It's kind of dumb to think about that, but that date that was issued is your starting timeline of when you can actually close. So that date's pretty critical, and it has to be done within 3 days of taking applications. So that date is kind of just seems like it's just a date, but It's kind of important. Then obviously your name, the property address that we are buying or refinancing, double check it. There's always a chance that somebody fat fingered something, just double check it. And then in this case, you could have a sale price. If you're doing a purchase, your sale price is going to be listed there. Once again, look at it. Make sure that is the amount that you settled on. Maybe there's an addendum that the lender didn't get. Pay attention. Okay, then going to the right side on the top, it tells you your loan term. In most cases, you're going to see a 30-year mortgage. That's just kind of the standard. I can't even tell you the last time I did a 15-year loan, but 30 years, what it is, and then what we're doing the loan for, purchasing, refinancing, and what type of product it is. If it's just a regular Fannie Mae FHA type loan, VA, USDA, they're going to be fixed. For the most part, many loans are just fixed. There are adjustable rates, there are those kind of things, but for the most part, you're going to see a fixed rate there. If you do see that says ARM, that should be like light bulb. Did you want an ARM? Did you want an adjustable rate? Maybe better just double check there. You're not going to see prepayment penalty or no prepayment penalty, spit that out, in that spot, but it is later down the form. Loan product, make sure your box is marked for what it is. If you thought you were doing an FHA loan and it's marked conventional or vice versa, make sure. If you thought you were doing a VA loan and it's marked conventional, make sure. Just double check the loan product that you've got is the one that you intended to have. Now, in this case, let's say this disclosure shows FHA and you would talk to your lender multiple times about doing conventional. There's this thing called the telephone. You can dial a number and call me, or you can shoot a text and say, hey, I thought we talked about doing conventional. Why is this box marked FHA? Oh, hey, by the way, this is why. Ask the question. It's pretty simple. I know that's shocking to just ask a question, but ask a question. And then the loan ID number, that is going to be the loan number that is tied to our files. And, if we had 15 John Smiths, that loan number is going to be super critical. And then if the rate is locked or not, that's also something to pay attention to. You as a consumer are ultimately the one that has the authority to lock the rate. From the lending side of things, if you say, I want my rate locked today, and I'm like, the market says it's actually going to probably trend down. Are you sure you want to lock? Yep, I want to lock, I want to lock, I want to lock. I have to lock it. Now, if you have made that conversation and said, hey, I want my rate locked, and you get this form and it hasn't been locked, one of two things could have happened. The form got sent out before the rate lock happened, so there'll be another one coming right behind it. So your loan might be locked. This one was just already sent, and so it has to be signed. These documents have to be signed. Even though this one might be superseded by this one, by this one, by this one, it has to be signed. So just realize, don't fight me on that. It just has to be signed, even though we know some of the terms could adjust. This is not a legal binding document in a roundabout way. If you say, you know what, I just don't want to do this loan anymore, I am not going to hold you to, oh my gosh, you signed this loan estimate, you have no choice, you have to close. And any lender that's doing that, shame on them and fire them. But anyways, your rate lock is going to tell you if it's locked or not, and then when it's locked through. Now, we have to remember this is important because this question comes up quite a bit. Let's say my rate is locked for till December 1st. Let's just use December 1st. My closing date is November 25th. You panic because like, wait. Is this going to be an adjustable rate? I'm only locked in till 12/1. No, that means I have to have your loan closed before 12/1, or I just have to extend the loan, and there could be some costs behind that. So we lock those interest rates in for the amount of time that we need for the closing. And that's definitely a misunderstood thing. Okay, so on the next section down, we go into the loan terms. You'll see like a big black bold thing that says loan terms. And this is a big thing to pay attention to, loan amount. Now, on an FHA loan, you're going to see a different loan amount here than you plan because we have upfront mortgage insurance that gets financed in. So if you are doing a $300,000 purchase and you put $15,000 down and you're doing an FHA loan, you're not going to see a loan amount of $285,000. you're going to see a higher number because that upfront mortgage insurance gets added in. So just remember, if you're doing FHA, that number is not going to be accurate based off of what your mind thinks it is, based off of what you're doing for your down payment. Once again, ask the question. Now, on page 2 of this, we're going to get into the explanation of where that mortgage insurance is so you can actually see how that works. And then interest rate. And pay attention to this little column. Can this amount increase after closing? So on the top of that, it says loan terms. Go like along the side, and it says, can this amount increase after closing? There should be a whole bunch of no's. Yeah, there should be some no's there, because you don't want your loan amount to increase after closing. You don't want your interest rate, and you don't want your principal and interest to increase. You just don't. I think I'm a normal soul when I say we don't want that number just to increase. And then we jump down to the prepayment penalty box. See, up there at the top, it says it's a fixed rate and what loan product, but it doesn't say anything about prepayment penalty. And you want to make sure you have one or you don't have one and you're aware of which one that is. So prepayment penalty, no. A balloon payment, no. Hopefully those are the situations that you're in on kind of a standard type loan. Now, real quick, let me explain a prepayment penalty. Prepayment penalty comes into place if you pay off the loan within a certain time frame or down by a certain amount. If there's a prepayment penalty, you'll have an extra chunk of money. What it standardly is 6 months of unpaid interest. So if you had a prepayment penalty, a 1-year prepayment penalty, and you paid it off at month 7, then you're going to have whatever that investor would have made in interest times 6 as the penalty. So it's not a pretty number. Back in the subprime days, there was prepayment penalties on everything. I know with all the laws changing, that definitely shifted the gears big time on that. And then a balloon payment says, hey, I'm going to tell you what your monthly payment is over the next 30 years. This is how much you'd be paying to get that paid off in 30 years. But at year 15, whatever you owe, you have to pay it back right now. You either refinance out of this loan or you can write me a check. But if you have a balloon payment, whatever that balloon date is, whatever the principal balance is on that plus interest, you're writing a check for it. So you always want to just make sure prepayment penalty and balloon are no most of the time, or more than likely you're aware of that because you would have talked to me about wanting that feature. There would be some reasons why we would want it, but not very many obviously. Okay, then jump down to projected payments. Now, I want to talk to you about the word estimate. If you look in Webster's dictionary, it's not like in my brain exactly what estimate means, but it's not perfect. It's just, this is as close as we can get to what it's going to be, but the word estimate needs to be in your head. Don't panic if we're off a few shekels. I promise we'll catch up because we've got some things we've got to verify. Okay, under the projected payment, you're going to have what goes on. Now, if you have mortgage insurance that's going to fall off, if you have mortgage insurance that's there for the life of the loan, you're going to see different columns. So one column could say 1 to 8 years, here's your breakdown because this is mortgage insurance in this column. On the next one over, it's going to say from 9 to 30, it's a lower payment because the mortgage insurance went away. So if you've got mortgage insurance on your loan, there could be 2 columns, and just be aware of that. If you don't have mortgage insurance, obviously you're probably going to only have 1 column. If you have FHA mortgage insurance and you're taking maximum financing, you're only going to have 1 column because the mortgage insurance doesn't go away on a maximum financing FHA loan. It's just there. Now it goes down as a tiered basis, but that's another episode. Okay, and then it breaks down mortgage insurance and your estimated escrow. Remember the word estimate. Estimated, estimate. We don't know this number perfectly. Could we have got a hold of the county and found out what the property taxes are? Yes. Home insurance? Yes, but not very often do we have home insurance figured out when this form has to go out. And then your estimated total monthly payment. And then below that, it goes into what else is included and if it's in an escrow account. So what is my taxes and insurance and any like HOA dues or any of those things per month, and that's separated out. And then the boxes are marked accordingly. So property taxes, home insurance. The other box could be, do you have flood insurance? Do you have HOA? Do you have any special assessments that we've got to put in there? And each county and each state is just a little bit different. And then it's going to tell you clear over on the right-hand side, is this an escrow? Basically, an escrow account is set up to have the mortgage company pay your taxes and insurance when they come due throughout the year. You're ponying up money every month to stash it into this little account that they pull from to pay the taxes when they're due and the insurance when they're due. And that's why you have those yeses or nos. Same thing. If you don't want an escrow account and you have that option on your loan and that says yes, hey, loan officer, I don't want an escrow account. This says yes. Oh, shoot. Okay, yeah, I didn't know that. I'll fix it. Once again, you still have to sign the form. We'll fix it. And the other form above it will supersede it. Okay, and then it goes down to the bottom. Closing costs. So exciting. So exciting. In this, it gives you a lump sum number, but then off to the right hand side, it explains what is there. So you've got a breakdown of your loan costs, other costs, and if there's any lender credit. And let me give you a little bit of a tip about a lender credit. If a lender credit is disclosed initially, it can never go away. So if your loan officer put $1,000 lender credit at the closing table, you have to see that $1,000 lender credit. It's going to be there and you'll see it. Now, the breakdown of those are going to come down on page 2, but when it says includes X amount in loan costs, X amount in other costs, X amount in lender credits, the loan costs are like title stuff, appraisals, origination fees, discount points, all of that. The other costs is all of your escrow account setups, your prepaid interest and all that. And we're going to dive into that deeper, but that's where those two separations come in. And then the estimated cash to close. Now, if this is in a positive position, you are bringing that money to closing. If it's in parentheses or a negative, you're getting that back. So keep that in mind that, and obviously it's going to be explained a little bit further, but if it's in parentheses or a negative, that's money coming back to you. If it's in the positive, that is what you're bringing to the closing table. So anyways, let's jump to page 2. Okay, page 2 is easily skimmed over because I feel like there's a lot of thought process behind, well, it is what it is, or the seller is paying for it, I don't really care about it, or I trust my loan officer and I'm not going to ask the questions. Ask the questions. A good loan officer can answer this, and on top of that, I would say defend what they're doing here. I'm going to pick on this particular loan estimate, and I'm not going to obviously divulge who this is, but I want to explain the number that I see on this form, which is probably going to be different than what you see. Okay, so in section A, that is the money that's actually going into the originating lender's office. Most of the time you'll see origination fees, discount points, processing, underwriting. Those are kind of the top ones that you're going to see. Sometimes there's an application fee, but those are the fees that actually go into the office that is originating the loan. Now, on this particular one, I want to talk about the difference between origination points and discount points. A discount point is actually taking money and buying a lower rate. So today I can lock at 5.875. It's not going to cost me anything, but I want to buy 5.75. It's going to cost me $1,800. That's going to be listed as a discount point because I chose from a 5.875 to a 5.75, and it's going to cost me some money to get there. Now, on this particular one, I want to explain this. Discount points are pretty frustrating sometimes. Sometimes we're choosing to buy that rate down because we want a lower rate. It makes sense for us to buy a lower rate down. I'm not a huge fan of discount points, but another side of discount points is sometimes it just costs a lot of money just to lock the loan. So I'm going to go to Walmart and I'm going to buy this bar of Dial soap. It costs $5. It's inflation, so I chose a big number. It costs $5. I'm giving you $5 to buy that Dial soap. It's just how much it costs. I don't get to negotiate that. I don't get to, hey, Walmart cash register lady, I really only want to pay you $4 for this. No, we don't get to do that. It's just the cost to purchase the soap, just like this. So in this situation, this gentleman has a really, really low credit score. There's a huge risk to the investor. So we have a certain interest rate that he has to stay within for his debt to income ratio to be where it needs to be. It's going to cost him $13,000 just to buy the rate. Is credit score being as low as it is and where we have to land this, he has a discount point on this loan estimate of $13,000. Now you're panicking. Well, this is the cost of just purchasing the interest rate. He doesn't It's like, okay, maybe I don't want a 5.875 rate at costing me 13 grand. Great. Let's go 7%. It's still going to cost you 8 grand. It's just costing to lock that rate in based off of the information on that loan file. So sometimes discount points are a little bit misunderstood because like, hey, I don't want to buy my rate down. Yeah, this is just like to purchase the rate. You don't get to decide. Sorry. If you want to buy the rate down, it's even more. If you want to have a higher rate, that's fine, but you're still going to have to purchase that because the risk factor that's on that loan. Processing fees and underwriting fees are 100% junk fees in the best layman's terms I can tell you. We still have to pay a processing department, and you want a processor involved because there's checks and balances in mortgages. There is mortgage fraud all over the place, and loan officers can be shady. And a processor is doing double checks to make sure that are those pay stubs cut and pasted? Are they um, does everything just line up and feel good? An originator has a relationship with the borrower and has some compassion and love and gets to know their story and just like, oh, it's okay, they're good people. Processor sits back and doesn't, they don't get the relationship with the borrower. They simply are having the clerical side of things. So that line item usually in processing is to pay that processor. And then underwriting, they are required. You have to have an underwriter review the file. That's just required. Now, are we going to get to the point that we have an AI system completely underwrite a file? We're already there. But you still have a human touch that has to go on with certain pieces of it. So we already have AI capable of doing, I would dare say, 75% of our work. If all the borrowers would get on board and do all of the electronic connections, I bet 75% of our stuff is already electronic, but we still have a human interaction that has to go on, and that underwriter has to sign her name or his name to it. And there's a fee for that. So that's always in there. And the application fee, I hate this fee. If you have a loan estimate that has an application fee, I think it's shame on that lender. So you put an application into me and you say, hey, I want to see if I can apply for this loan. Great. It's going to cost you $195 just for me to look at your application. Why? Like, I understand you paying for your credit report because that's a third party fee that actually has to go to a third party and there's actually a bill involved. But an application fee, why? Why charge $200 for that? And usually $195 is kind of the standard. But I mean, everybody does business just a little bit differently. I've never charged an application fee, nor do I plan to. Okay, so now go down to section B. Now, if you have other fees in that section A, I would ask what they are for, because I just don't feel like there should be much more in that section A. Origination fees, discount points, processing, underwriting, and an application fee. Origination. I forgot to explain that. Origination fee is basically, and I think the industry is kind of moving away from an origination fee, and they're all getting disclosed as a discount and it's kind of a soapbox moment for me and discount points and origination fees. So I'm not going to go down that rabbit hole, but an origination fee is basically, usually its standard is 1%, and it's paying the originator. Basically, I'm charging 1% for me to be able to do this loan for you. Just for kicks and thrills. When we were in the subprime days, it was nothing for us to have a 3% origination. Could you imagine that? I mean, loan amounts were significantly lower, but I remember one of our loans that we did, we had a $350,000 loan and 3 points on the front of it. That's do the math, 350,000 times 3% is a big number. Okay, so let's now go to section B, the services you cannot shop for. What should be here is more than likely like appraisal fee, credit report, flood certs. Those companies, we don't get to choose who we're using. Well, in a roundabout way. The credit report company, we have to pull through. We vetted them. They vetted us because we're passing really big personal information back and forth. You can't come to me and say, here's my Credit Karma credit report. Can you use it? No, we don't get to do that. To actually process the mortgage loan, we have to pull a credit report that we have ownership and connection to, run it through our automated systems. You don't get to shop for that. You don't get to provide it. We have to provide it. Appraisal has to go through a third-party portal, thanks to our BFF who put out the new appraisal laws, which thanks to the shady people in the industry, we had to have appraisal laws because there was threats that if you didn't come with this value, I wasn't going to pay you, or I'll pay you an extra $1,000 if you can hit value. Yeah, that crap's not okay. So thanks. We now have to have an appraisal board, which is basically just a middleman communicating with the appraiser so that the loan officer can't. Super awesome. We can't change that. We just have to order the appraisal through the appraisal desk, and you can't provide us an appraisal. There are cases that you can, like if you had your loan turned down somewhere else and they already did an appraisal, sometimes we can do an assigned appraisal, but still with that, we're going to go through their portal to get the information for the appraisal. Flood cert, if there is a flood information in there, that you have to order it through the flood department that we have lined up with to make sure you are or you're not in a flood zone. Okay, now on the C section, this is services you can shop for. And this is probably a little bit of a pet peeve that I have. Did you know the borrower is the one that has the rights to choose the title company? They have the ones that the rule is borrower chooses. But what's really fun in a purchase transaction is real estate agents have certain escrow officers that they want to use, which is fine, but they don't even give the borrower the choice. I mean, sometimes borrowers will pipe up and say, "Hey, my mom's got a really good friend as an escrow officer. We want to use them." But for the most time, for the most part, real estate agents dictate our lives on that. They want control of who the escrow account or the escrow officer is, the closer who's actually going to do the paperwork closing for us, which is fine. It's not that big of a deal. It's just kind of frustrating on my side sometimes as a lender because I'm the one working with the title company mostly. And sometimes escrow officers are hard to work with because they feel like they have to cater to real estate agents. And that's fine, but you're working with me and I'm the one giving the money. So maybe we should have a relationship. So shout out to the escrow officers that actually care that the lenders exist and stop catering so much to realtors. We're all in this together. So maybe we should all treat each other as a big team. You know, there's a little PSA out there. Anyways, so you'll see different things on here. If we have like an engineer cert for a manufactured home, that'll be on here because you can choose who we get that engineer cert through. Title fees are all going to be on here because technically you get to choose which title company you go through. Now, these are all very estimated: title insurance, wire fee, courier fee, endorsements, um, if it's a refinance or reconveyance to release the mortgage, those title fees that are on there, technically they're listed under things you can shop for because you get to choose the title company. Still an estimate though, because we don't have all that verification from the title company perfectly yet. So we can go onto their websites, get a title fee sheet, download it, throw in this information, loan amount changes, that's going to shift us just a little bit. Sometimes there's title insurance credits. We wouldn't know that from our initial fee sheet going out from just the online version of the title company. So those are the actual closing costs. This is how much you're paying a third party entity of some sort to do work for you. I can't say that there's no financial gain for you. I think I can. I think that's a pretty safe depiction. There's not really a financial gain here. You've paid for a service. This is how much that service costs. Now, on the other side, the right side, this is a big misunderstanding. These are all listed as closing costs, but they're not necessarily closing costs. They're costs that have to be included to get everything set up how it needs to be set up. Your escrow account, the daily interest, all those things. So we're going to go through that. Okay, so the top of this, more than likely, is your recording fee. The recording fee is I'm recording the new name on title and the security instrument. In our case, in the state of Idaho, it's a deed of trust, and that's getting recorded on title. And there's a fee per page that the county recording office charges, and that's going to be at the top of that page. And then we jump into the prepaid things. Prepaid insurance is a big beef people have. Why am I paying for insurance upfront for a whole year? I don't know. We go back to the golden rules. He who has the gold makes the rules. There you go. But if your home isn't insured and it burns down, there is nothing protecting the investor that they're going to get the money back. They're going to make sure that insurance is paid out a year ahead and just make sure that there's no chance that there's no any lapse of insurance at all. It's pretty critical. So I would ask the question, but I can understand the logic. Sometimes I'm like, no, that's kind of dumb. This one I can understand the logic. And then if there's any mortgage insurance premium that we have to pay up front, that is not usual. You don't usually see mortgage insurance in this column. And then prepaid interest. So the day of the month that you sign, let's just say the 15th, and there's 30 days in the month. We sign on the 15th, we fund on the 15th. We have to pay the interest from the 15th to the 30th as a closing item because we skip a month of payment. So let's just use the month of October. I close on October 5th. Well, let's use August because August has 30 days. So I close on August 15th. I have 15 days of interest that I have to pay at the time of closing to pay all of August interest. My first house payment is not due till October 1st. Well, I have to pay August because when I pay my October 1st house payment, I'm paying September's interest. So you're always paying interest in arrears. So my October 1st house payment pays September. My November 1st house payment pays October. So that's why we have to have those remaining days of interest paid at the time of closing so that we're only having to catch up those 30 days. And then upfront taxes. Sometimes those prepaid taxes come into play when taxes come due within basically 60 days of when the payment's coming due. So in Idaho, taxes are due in June and December. Closing in the month of November, I have to pay whatever taxes are due in December because the servicing company is not even going to be receiving a payment from me until January 1st. Taxes were due in December. So we have to pay those taxes at the time of closing that are due within that window so that we don't have any delinquent taxes. Not very often do you see that, but there's these 2 windows in the state of Idaho each year that like, hey, taxes we paid, taxes we paid. Now, before I jump down to the escrow account, there was one piece that I missed. If you jump back over to the B section, because the loan estimate I'm looking at is not FHA. If you look at the B section, that's where you're going to see your upfront mortgage insurance premium. If you have an FHA loan, if you say, okay, I'm doing a house loan for $300,000 and I'm doing $15,000 down, my loan amount should be $385. Right, unless you're FHA. Then you go to this page and you see the FHA mortgage insurance premium. That little premium can be financed in. So you're going to see that premium added to that 285 number. And that's what you're going to see your loan amount is. Does that make sense? So if my mortgage insurance premium is $5,000, purchase price is $300, I'm doing a $15,000 down payment, you would think your loan amount is $285, but I have a $5,000 mortgage insurance premium, so I'm actually doing a loan for $290. So $5,000 of that money is going to the FHA people. The other $15,000 is coming from me, but it is actually financed in. Now you can bring it to closing if you want, but it just helps reduce the amount of money you have to do at closing. Sorry for forgetting that. Now we're going to jump back over to the right-hand side. Just glad we didn't get to all the way to the end. Okay, so now we're in section G, initial escrow payment at closing. This is what we're going to set your escrow account up for. Depending on when taxes come due and home insurance come due, will dictate how many months we're going to pull. Now, by law, they can only have so much cushion in that escrow account. So if we have taxes due in June and we're closing, say, January, they're going to collect more months because we have only a couple months we're going to be paying before those taxes come due. So you may see 4 or 5 months being collected, but that's because you're not paying into that escrow account until later down the line, and they've got to have enough money sitting there to pay those taxes in June and pay those taxes in December in the state of Idaho. That's when taxes are due in the state of Idaho. So that number is zero control of the lender. Zero control of my desk. I don't have any control of that. It is 100% based off when home insurance comes due and property taxes come due. So it is what it is. That's one you just have to say, okay, it is what it is. Okay, under H, if you're doing a purchase, you're going to see title insurance optional. This is kind of an interesting thing. When some of these laws changed a few years ago, and title insurance and how it was disclosed and all of this, there's this random owner's title policy that's optional. I don't know that we ever see it on any type of closing statements. We have to disclose it. And I think it's dumb because if we never see it, why do we even have to disclose it? Because it's not charged, but we still have to disclose it. But whatever. So that's what you're going to see under other. And then everything always just added up. Now, down in the bottom where it says calculating cash to close, it's pretty cool to watch all of this stuff, but unfortunately, you don't see a lot of details. So total closing costs is all the numbers added together, both columns. And then if you have closing costs financed with basically, that's when you're going to see your FHA mortgage insurance there as well. And that's being financed in. And then what is your down payment? How much are you bringing to the closing table for an actual down payment? That's your next line. And then in a purchase situation, did you do any earnest money? You're going to see that deposit in a negative number. And that actually credits out. And then seller credits. This is like, in most cases, just a lump sum number. And now, if you had negotiated your contract that said, um, seller's going to pay $15,000 of my closing fees, but you actually see like $17,000 as a credit, you're like, wait a minute, hold on just a second. The seller said they were only paying 15, right? But the seller's, in most cases, responsible for the title insurance. And so you'll see that as a seller paid fee sometimes as well. So if that number is a little bit higher, it's definitely worth asking the question, but be prepared that probably the answer to the question is the title insurance is on top of what the seller also said that they were going to pay for. And then any other additional credits. And this one drives me crazy because there's no explanation for it. I can throw $100 credit in there. Nobody even knows what it's for. There's a little box that I had to say what it was for, but it's just this lump sum number. But I mean, it's an adjustment in other credits, so I guess it's a good thing for the consumer side. So that is page 2. Not a lot of information, but a lot of information there. This is how much it's costing you to get this loan. Now, page 3 is intense. So let's jump to page 3. Okay, page 3 is always looked over, but if you look at it, it's the one you sign, and it's just a lot of words and looked over a lot. Here we go. Pay attention to this one. Fees are really easy. This is how much it's costing. I can see it. This piece is kind of sadly looked over. Anyways, okay, same thing. On the top of it, information and who's originating the loan. And down in the comparison section, let's dive into this one. This is so sad when you see these numbers. Okay, in this particular situation, my loan on this one, I want to say was $375. Let me look really quick so that I can make sure. $325. My loan amount on this was $325, and the interest rate on it was 5.99%. In 5 years, this person will have paid $134,960 in principal, interest, mortgage insurance, and loan costs. So all just the crap that you have to pay on top of how much interest, $134,000, almost $135,000. But of that huge number, only the number right below it, only $22,611 will have been principal. So in this situation, almost $135,000 all in, everything that I've paid, but I've only paid off almost $23,000. That's a sickening number. And I'm very much of a just pay extra. Even if it's $20, $50, just pay extra. If your monthly payment that you were told was $1,839, always pay $1,900. Set your budget up to always pay $1,900 and just pay that extra money. It will help that number. Anyways, that's just a disgusting number. Look at it. Not really much you can do other than, buy your rate down, which gets expensive. It's not necessarily the most solid advice, and that's definitely a case-by-case situation. But if this in 5 years line item does not scream the importance of adding a little extra to your principal, I don't know what does. This right here is absolutely crazy. Just add extra. Your annual percentage rate. This is probably the most misunderstood situation piece of interest rates. I have a note rate of 5.99 on this loan estimate. That is the interest charge that I am charging the consumer. Well, not me, but that's the interest that's being charged to the consumer. The APR, annual percentage rate, is this. It's the cost over the loan term converted into an interest rate, basically expressed into an interest rate. So what happens is my rate's 5.99. We have prepaid finance charges. Some of that information on page 2 is considered a prepaid finance charge. That's just the definition of it. They take that prepaid finance charge dollar amount, convert it into an interest rate, and they add that to the note rate. Okay, and that's where your APR comes in. So it's the cost of doing the loan in an interest rate format, and it gives you the ability to shop this just a little bit. It's like, okay, if my APR at this banking institution is 6.59 and they're giving me a rate of 5.99, but my APR over here is 6.39, and my no rate is 5.99. There's probably less discount points somewhere. So your APR is definitely a good shopping tool, but please don't get held up on, am I getting, wait a minute, wait. My one place says 5.99. Why does this say 6.545? It's an APR. Yes, pay attention to it. Yes, know what it means, but you're not being charged that higher interest rate. Now let's talk about the third line down tip, the total interest percentage. This is probably the piece of this form that I think, actually, I'm not going to give you my opinion on it because I'm sure there's going to be some haters that have something to say. But the total interest paid percentage, sorry, is the total interest paid over the full loan term. Okay, so the amount of interest you're taking divided by the loan amount and then multiplied by 100. That's where that tip comes in. So why does it look so high? Well, because it's, in this case, 30-year mortgage, and 30 years is a long time. I mean, you're a lot of interest over that 30 years. No matter if your interest rate was good or not, it's still a lot of interest. And when you look at an amortization schedule, which is, here's my payment breakdown and what goes to principal, what goes to interest, what goes to mortgage insurance, and every month there's an amortization schedule that just tells you what that's doing. Now, at the beginning of a loan, most of what you pay is in interest, little teeny tiny principal. And then as you go down, the pendulum starts swinging like a long ways down. And then you start paying more principal and interest. So that's really why that number is so high, is because there's so much interest on the front end of the loan. And then I guess the thing about it you also have to remember is most people don't keep a loan for 30 years. They either refinance it and keep repeating that 30-year loan, or they sell their home, or they turn it into a rental, or whatever the case might be. So sometimes there's like, yeah, are you really going to pay that whole thing? Probably not. I think average is, I want to say 7 to 8 years or something, somebody stays in a home. And just just keep in mind that that tip line item is just simply for information only. It once again screams at you, please make sure you're paying attention to what you're paying on your mortgage. Pay a little extra if you can. It's just not going to hurt you. It's not going to hurt you to have it go to principal. Okay, so there's that section. Now, the other part of it on the bottom is, I'm not saying it's not that big of a deal, but it really is. I mean, it looks like a bunch of fine print, but it really is not that big of a deal. So let's just run through it. Appraisal. We may or may not order an appraisal. There might be an appraisal waiver, but in the event you have an appraisal, you'll have a copy of it. If you don't close the loan, you're still responsible for the appraisal. It's just, and that's kind of a lender discretion. Once again, it costs us to have a third party do the work. Therefore, you should probably be paying for it as a borrower if you decide to bail on the loan. And then the assumption. An assumption is an interesting thing. Most government loans have an assumption policy. So if you wanted to let somebody take over your loan and the loan terms and how much years you have left and all that, this is going to say yes or no. Conventional loans do not have an assumability option. FHA, VA, and USDA do. Homeowners insurance, you're required to have homeowners insurance. If you do not have homeowner insurance on your property, if for some reason, I doubt this would happen, but if you're escrowed, you shouldn't worry about it. But if for some reason you do not have insurance, there will be forced place insurance put on your home. So it's just basically saying you have to have insurance. You don't get to choose that. Late payment. If you don't make your payment, there's an automatic grace period on mortgage loans. So if you don't make your mortgage payment before the 15th day of the month, there is a penalty and you get charged an extra chunk of money for that to be not posted until after the 15th day of the month. So yes, you have clear till the end of the month. Make sure you post that before the 30 days is over, but you do get an extra penalty. So just don't just pay it on time. Pay it between the 1st and the 13th. There's nothing wrong with that. Refinance. This is kind of an interesting thing. Refinancing this loan will depend on your future financial situation, the property value, and market conditions. You may not be able to refinance this loan. Okay, good to know. Nobody reads that, but just so you know, everybody who was talking about 2-1 buy down saying, oh, the rates are going to come down, everything's going to be good, you signed something saying, hey, good luck to you. This may not be able to be refinanced. You might be stuck in this thing for 30 years. Sucks to suck. That's really how they should word that. I think that would be kind of cool if they put that in some sort of a disclaimer. But servicing. Most mortgage loans are serviced at a different place. So you have different hands in the pot here. I originate the loan, I make sure the loan closes, you buy your home. Then we have people who make money on servicing the loans. Their job is to collect the payment and make sure you make your payment on time, and that is the servicer. In most cases, most mortgage companies sell the servicing rights and they don't service them in house. So that's basically saying, hey, are we going to keep it in house? Or are you going to be paying us? Or are we servicing out there in that little portfolio for them to take care of in the servicing portfolio? And then that's the nuts and bolts of a loan estimate. And then you're signing the bottom of it. I think the biggest thing to remember on the loan estimate piece of it is you are protected as a consumer, that there has to be a valid change of circumstance to send a new one. So say I send it out and it's not locked, then 2 days later I lock the loan. I'm going to send you a new one. My change of circumstance says my rate was locked. This is why you're getting a new form. I change a loan amount. Here, that's a valid change of circumstance. Here's the new form saying my loan amount changed. What else would it be? Maybe we disclosed an appraisal and we got an appraisal waiver and we don't have to have that. Do I necessarily have to disclose that loan estimate? No, because the fee's going away. But sometimes people just like to see the right information. Now, in the event that when we do the application, I've locked your interest rate already, I have your home insurance, and I have your property taxes verified, or still as an estimate, and 2 weeks goes by. Actually, that's a long time. I don't want to say 2 weeks. 2 days goes by and I verify your home insurance and your property taxes. And the only thing that's changed on that form is that my insurance went from $90 to $93 and the property taxes went from $150 to $167. I don't need to send you a new form. That's part of the loan estimate piece of it. And we'll make sure all those numbers are tightened up to send to you the closing disclosure, which we'll tackle that on a different thing. So anyways, I hope that was informative. My task to you is make sure if you do have a loan estimate form, make sure you actually read it. Make sure you understand those numbers. Ask the questions. If your loan officer can't answer the questions, shame on them, fire them. That's what it is. If they can't answer the questions, fire them. It is that simple. Because in the industry that we are in and the professional seat that we sit in, if you do not have the ability to explain the disclosures clearly and accurately to the consumer, you should be fired as a loan officer. So there's my little soapbox tangent. Anyways, with that being said, enjoy your day. Thanks for taking the time to listen to this, and hopefully you understand a loan estimate more. Thanks so much for listening. I really appreciate it. So stay tuned. We are going to learn some more next time.